You see a stock up 40% in a week. You did not buy it. Your chest tightens. You open your trading app. You buy the top. The stock drops. That feeling is not random. It has a name, and it costs traders billions of dollars every year. As a new trader, I experience this constantly. Stocks rising in the news. I bought them high, more than once. I always felt like the market was moving without me. FOMO, the fear of missing out, is not a character flaw. It is not a sign of greed. It is a hardwired psychological response, and in trading it is one of the most consistently destructive forces that exists. A 2023 study in the Journal of Behavioral Finance found a clear statistical pattern. FOMO-driven trades underperformed the market by an average of 12% annually. For a trader starting with $50,000, that shortfall is meaningful. Over 5 years, the compounded gap becomes significant. The total lost returns reach roughly $40,000. And that figure does not include the downstream damage from all the subsequent decisions that FOMO distorts. The mechanism follows a predictable structure. First, you observe an asset rising sharply. Second, anxiety builds about being excluded from the move. Third, you act without a pre-existing plan. You buy near the peak. Fourth, the asset corrects. You sell at a loss. Then the cycle resets. Each step feels fully justified in the moment. Each step in hindsight was avoidable. The same pattern appears in Forex just as much as in stocks. Watch a long, strong trend and the mind begins to believe it will never reverse. You hesitate, worried about buying the top. The trend accelerates. The fear of being left behind finally overrides the hesitation. The moment you buy, the reversal begins. It feels like a curse, but it is not a curse. It follows a pattern. The physiological effects are real and measurable. Traders who score high on FOMO assessments show elevated cortisol levels during market hours. They trade more frequently. They hold losing positions longer than their own rules allow. They close winning positions before their targets are reached. The damage is not purely financial. FOMO erodes the decision-making framework itself. Each reactive trade makes the next one more likely. There is one more dimension that makes FOMO particularly persistent. It is self-reinforcing. When a FOMO entry occasionally works, it validates the behavior. When it fails, attention shifts to the next potential opportunity rather than the pattern. Left unchecked, the cycle grows stronger over time, not weaker. The psychological roots of FOMO in trading trace back to 1979. Daniel Kahneman and Amos Tversky published their work on prospect theory that year. Their central finding changed how economists understand financial decisions. Losses feel roughly twice as painful as equivalent gains feel good. That asymmetry is the engine of FOMO. It is not greed pushing traders to chase rallies. It is fear. Specifically, the fear of a gain that never belonged to them. Prospect theory is not just an academic concept. Every trader lives through it personally. I am no exception. Losing money and gaining the same amount, the loss hits roughly twice as hard. That asymmetry drove me into a pattern I see in many traders. I let losses run. I cut winners short. The math compounds silently against you, and the behavior repeats without a deliberate structural change. Social media has intensified this dynamic to an extreme degree. A 2022 study from Baruch College analyzed activity during the GameStop short squeeze. That squeeze took place in early 2021. Posts using FOMO-related language spiked by 400% just before the stock peaked. Most buyers who entered during that period lost money within a week. The data trail was visible in real time. The behavior driving it was not analysis, it was fear. Neuroscience explains why rational thinking fails under these conditions. When you observe another trader's gain, your brain activates the same reward pathways as a personal gain. This is mirror neuron behavior. It is the same mechanism that makes you flinch when you watch someone fall. The response is automatic. What determines the outcome is whether you act on it. Recency bias compounds the problem further. After extended rallies, traders overestimate the probability that prices will keep rising. A 2021 paper from the National Bureau of Economic Research documented this pattern directly. The study focused on periods following market rallies exceeding 30%. In the next quarter, these investors allocated 67% more capital to equities. Their returns were negative in 72% of cases. Peak confidence arrived exactly when caution was most warranted. Platform design adds another layer of risk. Mobile trading applications are built to reduce friction between impulse and execution. A study in management science found a direct correlation. Users who switched to zero-commission apps increased trading frequency by 40%. Their risk-adjusted returns declined by 22%. The technology did not create FOMO. It collapsed the delay between feeling it and acting on it. The final factor is social comparison. Watching others profit from an asset you chose not to buy is not a neutral experience. Research from Harvard Business School found that perceived peer success activates the same neural circuits as personal financial loss. Your brain does not process another person's win passively. It registers it as you falling behind. That is not a metaphor. It is how the brain is wired. The clearest way to understand FOMO is to watch it play out in real decisions. Consider a trader we will call Marcus. In late 2021, Marcus had researched Solana months before its major price run. He had reviewed the fundamentals and concluded the risk was too uncertain. He chose not to buy. Then Solana began its run. It climbed to nearly $250. That move took just 6 weeks. Marcus watched from the sidelines as the move accelerated. Marcus held out until Solana crossed $200. At that point, he entered with $30,000. 6 months later, Solana had fallen sharply. It was trading near $34. He had lost roughly 90% of that position. His initial analysis had been sound. FOMO bypassed it entirely. Marcus is not a statistical outlier. The Financial Industry Regulatory Authority has documented a consistent pattern. Retail investors who enter speculative assets in the final third of a price run face a steep cost. On average, they lose about 41%. The loss period typically spans the next 12 months. This pattern repeated through the dot-com collapse. It repeated through the 2022 crypto correction. FOMO always arrives late. It always stays too long. But there is a second consequence that often goes unmentioned. After enough FOMO losses, the fear reverses direction. The fear of buying the top becomes paralyzing. Every valid setup starts to look like a trap. You stop entering entirely. That paralysis cost me several significant trend moves. I watched setups develop exactly as I had prepared for them, and I froze. FOMO had transformed into its opposite. Both versions destroy returns. A second case shows a different form of the same problem. Call her Diana. Diana caught a trade early and held through a significant drawdown. When the position recovered and moved into profit, she sold immediately. The fear of losing the gain overrode her original target. She exited at a 30% gain. Over the following month, that same position rose another 80%. Diana's version of FOMO was not about missing a rally. It was about losing what she had already earned. The mechanism is identical. The financial result is the same. The third case catches even experienced traders off guard. Call him David. David had spent years building a systematic approach. He had clear entry signals, fixed position sizing, and defined exit criteria, all written down. One afternoon, a stock he had been monitoring made a sharp move without triggering any of his entry conditions. He told himself the fundamentals justified an exception. He entered the trade manually. The position fell 8% over the next 3 sessions. David had strong discipline in general. He had built a careful structure. But FOMO created a temporary override at the exact moment that structure was needed most. Late entry, early exit, rule exception. These 3 failure modes account for the vast majority of FOMO-related trading losses. They look different on the surface. They share a single cause. A decision made in response to an emotional signal, not a pre-established plan. FOMO is manageable, not through discipline alone, through structure built in advance. The first tool is pre-commitment. Before opening any position, write down the specific conditions for entry. Write down the price target. Write down the maximum loss you will accept. This process forces deliberate thinking before the emotional signal arrives. A 2020 study in psychological science confirmed the impact. Investors using written pre-commitment rules made impulsive trades 73% less often than those without them. The second tool is a mandatory waiting period. If you feel the urge to buy something that was not on your watch list, do not act immediately. Wait 24 hours. FOMO signals have a short half-life. In most cases, the urgency fades before the window closes. If the opportunity is still valid the next day, you have now made a deliberate choice. You have not reacted to a spike of anxiety. The third tool is deliberate position sizing. If the pull to enter a trade feels overwhelming, you are allowed to participate. But limit the position to 1% or less of your total capital. This eliminates the possibility of catastrophic loss while allowing the psychological release of being in the trade. You satisfy the emotional pressure without exposing your account to serious damage. The fourth tool is managed media exposure. Research consistently finds a relationship between trading-related social media use and reactive behavior. Reducing that exposure by roughly half correlates with a meaningful drop in impulsive trades. You do not need to quit entirely, but every highlight reel you watch is curated. You are comparing your complete experience, losses, drawdowns, missed setups, against someone else's selected best moments. Adjusting the input changes the reference point. For me personally, building a written rule set was the most effective change I made. Not intuition-based rules. Rules backed by backtesting, with documented positive expectancy. Following them mechanically removed emotional high buys from my trading. But the hardest part is not creating the rules. It is following them consistently, especially when FOMO is at its loudest. The fifth tool is outcome-independent journaling. After every trade, ask one question. Did you follow your process? Not whether the trade made money. A trade that followed the plan and lost is a process success. A trade that broke the plan and won is a process failure because it reinforces the wrong behavior. Over time, this shifts your focus from individual results to the integrity of your method. FOMO stops feeling like a signal and starts registering as a warning. None of these tools require extraordinary mental strength. They require setup in advance. FOMO is not a flaw. It is a documented universal response to specific triggers. What separates traders who build durable results from those who do not is not the absence of FOMO. It is the presence of a structure that FOMO cannot override. Every experienced trader has a FOMO story. The ones still trading have a system that outlasts the feeling. If this topic connected with you, subscribe and leave a comment with the one FOMO trade you wish you had passed on. We read every one, and we will see you in the next video.